Dennis Tubbergen here again. It's April the 3rd. It's Tuesday. I'm here with another economic update. I've got an article up here this morning from CNBC, and the title of the article is Economist Fears a 30% Stock Market Correction with Consumer Spending Maxed Out. Steen Jacobson from Saxo Bank cited several factors, including growing credit loans, a widening fiscal deficit in the U.S., doubts over infrastructure spending plans, and a potential trade war. Mr. Jacobson says, I think overall we've been pricing in for Goldilocks and we're closer to Frankenstein, to be honest. He added that in a scenario of a potential sudden economic recession, he sees a possible market correction of between 25 and 30%. Well, basically, Mr. Jacobson saying that consumer debt levels are getting very high. It's going to be difficult to have more debt-fueled consumption, which has been really driving this economy for arguably the last 20 years. He also is stating that a trade war could be the catalyst to ignite a downward trend in the market. I happen to agree with Mr. Jacobson, and I'm going to share with you just a few different slides that I put together here to make the point. This is the financial asset to disposable income ratio. And you can see that the ratio at the dot-com bubble peak was just under 500%. And then you can see that that ratio fell with stocks. At the peak of the housing bubble, it was about 500%. That ratio again fell with stocks. And today, we're calling this the everything bubble. It is significantly higher. So that is a huge red flag. Second red flag is the level of margin debt that exists on the New York Stock Exchange. The blue line on the chart is the S&P 500. The red line on the chart is the level of New York Stock Exchange margin debt. And there's a very interesting relationship here that you need to pay attention to. If you take a look here back at the tech stock bubble peak, when margin debt started to contract, so did the price of the S&P 500 just a few months later. Then at the peak at the housing bubble, you see margin debt pulled back, and a few months later, so did stocks. Margin debt now is at all-time highs. This data is through November of 2017, so that's red flag number 2. Red flag number 3 is something that we'll call the Buffett Indicator. This is basically market capitalization to gross domestic product. You can see here that the tech stock bubble that we were at 151%. You can see at the housing bubble we were a little over, call it 110%, and now today we're back at about 133%. So almost back to where we were at the peak of the tech stock bubble. So that's red flag number 3. And then finally, this comes from Advisor Perspectives, which is a very terrific website. If you want a lot of really good information, I refer to this website often. This is the S&P composite going back from 1871 to the present, and it's showing the real price in correlation with the Cressmont price-earnings ratio. And the Cressmont price-earnings ratio is really a smooth price-earnings ratio over 10 years. Now, if you take a look, whenever the price-earnings ratio has gotten up over, say, 20, we have seen a significant stock market correction. Go back here to 1929 when we saw stocks decline significantly. The PE ratio was 26.4. Then we go back here prior to the bear market of the 70s, and you see that we were over 20, another significant stock market correction. Tech stock bubble, 33, another significant stock market correction. PE at 24 here at the end of the housing bubble, another significant stock market correction, and we are now approaching that 33 level again. So we certainly have a lot of red flags pointing to the market correcting. I certainly believe that that analysis is exactly correct. I would say that a 25 or 30% correction, though, could potentially be a little bit light. So what should you be doing now? Well, you should certainly be protecting open positions in stocks by all of our official measurements this morning. The Dow, the S&P, the NASDAQ, and the Russell are all in neutral, no trend areas. That always happens at market turning points. So we think we're very close to a market turning point. And we think that we may have seen the highs for the year back on January 26th. So that is today's economic update.